Good morning, everybody. Apologies for the croaky voice. I appear to be coming down with whatever it is everyone else in the world seems to be having right now.
Oh, the plague has got him.
The plague has finally caught up with me. Like many things, like my STDs, I didn't think I could catch it twice, but here we are. Morning, everyone. You join myself and the magnificent Michael Brown for the morning blast. It is Tuesday, the 16th of December, all day. As usual, this is a very candid review and trading podcast, well, markets related podcast. Nothing we say is trading investment advice. Beware of trigger words. Again, this is recorded live, so we apologize if we say shit, fuck, or bugger. Hopefully we add some value on to your day. Hopefully we had to put a smile onto your face. Nothing we say is investment advice unless we say it categorically is yada, yada, yada. You know the score by now. Everyone's winding down for Christmas. Who gives a fuck? Michael, how are you?
Yeah, morning, mate. Morning, everyone. I'm same as everyone else, really. 4 days to go. I mean, we could call it 3. Does Friday really count?
No.
Does Thursday count? Does Wednesday count? Does Tuesday
count?
Very much. Get
Jokes
the vibe.
aside,
the year is over, to be honest.
Jokes aside, we have said about how, after Thanksgiving, a lot of people feel off the desk. And then after the FOMC meeting last week, even more people will be off the desk. And the thing is, most of the people that are still going into the city, well, not just the city, but, Wall Street or wherever it is, most of this week, the bigger desks and stuff will be made up with, catching up with people over Christmas drinks and stuff. So,
well, exactly.
So as we said yesterday, if you really don't have to trade in their liquid markets, don't fucking trade a liquid market. It's as simple as that, really. There we go. Shall I crack on with an update from our good friend Clive Lambert?
I was going to say that the trooper that is Clive Lambert is still going,
indeed.
Isn't he? So
indeed. Oh, we'll speak about something else in a second. I've had to pick up the slack because Zach's off today, but so the other news roundup might go to complete pieces. But also,
I was thinking the other day that Judith hadn't had a holiday for a while.
No comment. He's a good lad. He's a very good lad. Right, update.
And he's here.
When he's here. When he turns up, he's a great lad. So anyways, from quick market update from our good friend Clive Lambert, Futures Techs. Do check them out. And that is an endorsement if technical analysis is your bag. Starting off with the S&P, posted a doji yesterday. So obviously that means it's moved around, but pretty much closed where it's started today. Shy of its all-time high of 69.54. A short-term Fibonacci level we're watching is 68.33 on the downside, and a test of that was seen overnight, holding as Clive wrote his report this morning. Obviously, if you're playing this back, because obviously vast majority of people play this back, so tell us where it is now. NASDAQ saw red again, so no Santa rally as of yet. We're leaving it pretty late there on that side of the pond. The FTSE futures here in London went against the grain and put in a solid green candle on the chart yesterday. And 9,722 is the Marubozu support, which is a fan favourite. Be aware that this is roll season in equities right now. So obviously prices we're quoting are futures. So don't get caught out by that. Bunds are still struggling.
Not that I did actually get caught out by that yesterday, but
Oh really?
As someone who should know better, I am very, very ashamed to admit that.
So you should be. I'll tell you what, if it was someone that I can think of in South America, you'd be going absolutely potty.
Sorry.
I'm there. Sorry, that's a private joke, everyone. That's a private joke. But Michael knows I'm spot on, so that's all that counts. Right, where was I? Bunds still struggling on Marubozu, shy Marubozu resistance of 127.75 off the lows last week, which was 127.05. It's all got a bit uninteresting and scrappy in bonds at the moment. Euro dollar continues to head higher up to 1.1769. Yesterday, Bitcoin saw further weakness back to 85,140, so eyeing recent support at 84,000 and 80,500. Gold, the yellow metal, has posted 2 shooting star candles in a row, so some signs of tiredness to the upside on there. Silver, the silver metal, hasn't made a new time high since Friday, which is a change. Platinum is trading at levels last seen in 2011, when 1911 and a half was a high and failure. It got up to 1862 in the Asian session this morning, so all eyes on that. LME nickel, London nickel, looking weak back to 14,235 yesterday, the lowest level since April, when the low and the bounce was at 13,865. So all eyes on that one. In the oil benchmarks, Brent and WTI continue to with their recent weakness. Brent is getting close to the mid-October low and bounce at 59.93. On the continuation charts, the corresponding level is 58.40, so one to keep an eye on there. Below here will be at the lowest level since 2021. The recent rout in Henry Hub, so US natural gas continues. Gas oil also seen red. Gas oil is basically, think of it as European diesel, down to 618 618 and three quarters, so 75. So thinking about a retest of the 605 and a quarter low from October. TTF, which is European benchmark natural gas out of Holland, opened higher yesterday, but sellers responded and the bears are still bossing that one. Wheat in the US agricultural market sold off yesterday and so far today, down to 515.6. Iron support at 508.4, which was the low and a bounce in mid-October. Soybeans finally followed suit and is now testing support at 1,063 to 1,065, where we have a couple of Fibonacci levels and an unfilled gap from late October. And I know firsthand from my agriculture trading friend that everyone is eyeing for that gap to be filled. And gaps in charts seem to have a magical effect.
Oh, sorry. I thought there was going to be more then, right?
No, that's it from me.
Oh, right. Fine. Sorry. I'm still rather tickled from your South American reference, which absolutely no one else understands. But there we go.
Good one, right?
Yeah, very. It's also going to give a few other people a giggle when I go back to my desk.
I aim to please.
Oh dear. Anyway, moving on from that, where should we start this morning? Let's start here in the UK. I know we talk about the UK quite a lot, but that's where we are. So like it or lump it. We had the latest jobs data out of the UK this morning, and it was predictably grim. Headline unemployment rising to 5.1% in the 3 months to October. That is the highest level since January of 2021. And for reference, the highest level that we saw during the pandemic, that was 5.3%. Now, of course, we did have the furlough scheme back then, which did keep people on payrolls. It did keep unemployment lower than it otherwise would have been. But the fact that we are stood here in what is otherwise a normal period of time and comparing UK joblessness to how it was when the entire global economy was shut down is not a particularly great sign. In terms of leading indicators, according to the PAYE payrolls metric, employment fell by another 38,000 in November. By my maths, that is not only the third straight month that we've had a fall of 25 to 30 odd thousand, it's also the 12th month in the last 13 that PAYE payrolls have fallen. Clearly, the UK labour market continuing to lose momentum.
No one could have saw it coming. No one could. Well, apparently, this is completely unrelated to policy.
Nothing to do with Rachel Reeves at all, of course.
No,
yes,
nothing to do with the national insurance contributions, etc. Nothing like that. Nothing.
No, of course not. If, for any listeners who don't understand that, mainly Americans, that is very, very sarcastic.
Good point.
Despite the labour market continuing to lose some, earnings are rising at a relatively rapid clip. Overall pay rose by 4.7% on the year in the 3 months to October. Regular pay, when you strip out bonuses, rose by 4.6%. However, we have another big problem, because this earnings growth is firstly not only incompatible with a sustainable return to the Bank of England's 2% inflation target. If you dig into the details of the data, the ONS report that private sector earnings grew by 3.9% on an annual basis over that period, while public sector earnings growth rose by 7.6% in the same period of time. Effectively, what that means is that public sector earnings are growing at double the pace of earnings in the private sector. That is, in case you hadn't already worked that out, a massively unsustainable situation, although the government seem to have absolutely no idea or no desire to get a grip of
things. And this is the problem, right? Because then what's been happening is, well, it happened pretty much the day after they got elected, was that we saw strikes, and they know, the Labour Party are basically the owners of the Labour Party are basically unions. That's where the vast majority of their funding from. And of course, as soon as Labour got into power, people started striking, and the Labour Party just, basically rolled over and gave them whatever they want, and that's, and that begets more striking and people asking for more money. And unfortunately, I hate to say it, but it's like, as you said, it's ruinous for a country to go down that path. But not only that, but say they do say, reform or reform Conservative coalition get in next election, which is highly likely as it stands. Those things are incredibly difficult to unwind.
Well, exactly. The precedent has been set now. That's the problem.
Yeah. So we're talking a lot. We're talking, it's incredibly hard to unwind. And we're talking kind of getting a bit OTT, like generational kind of levels of kind of fuckwittery, which have kind of, which fuck us for a long time after Labour have left office.
And almost certainly will. Anyway, on that cheery note, we'll head across the pond. We had a few Fed speakers yesterday. Excuse me. We heard from your mate, Ryan, Fed Governor Stephen Miron. He was arguing that a gauge of underlying inflation in the United States is near 2%. God only knows what was in this gauge. Presumably, he's just taken out everything where the prices are actually rising to come up with that. He was also talking about how tariffs are not driving higher goods prices. And he was also repeating his view that keeping policy too tight will lead to job losses. Myron also confirmed that he is likely to, and this is bad news, stay on the board until a successor for his seat is appointed. Of course, his term is due to expire at the end of January. It is very, very likely that whoever Trump picks as the next Fed chair will be nominated to fill that spot that is going to be vacated by Stephen Miron early next year. And actually, on the race for the next Fed chair, it appears that Kevin Hassett is sort of faltering in terms of his front-runner status. CNBC, citing sources close to President Trump yesterday, revealing that Hassett's candidacy has received pushback from high-level advisors to the president. There is apparently, and please don't laugh at this, concern that the NEC director is too close to the president. Now, I find this quite frankly farcical, because the whole reason he's the front runner is because he is so close to the president, because Trump sees him as, basically a loyal mouthpiece who will do his bidding in the media. Oh, God. And apparently now, according to some Trump advisors, that's a bad thing. In any case, it does appear, and again, take this with a huge pinch of salt, because it's like The Apprentice on steroids, this whole thing. But it does appear that the race is now sort of more open than it ever has been, with it being a bit of a toss-up between Kevin Hassett and Kevin Warsh for the top job. And I can't remember who posted it yesterday, but as a wag on Twitter noted, is it too late for Christopher Waller to change his name to Kevin? Because he seems to have been entirely forgotten about at this point. Moving on from that.
Can we just commend myself for holding it together, because we had pushback, we had mouthpiece, and we had toss-up.
Yeah, well, you did very well there. Well done. Well done.
New Ryan, everyone. More mature flavour.
Sticking with the United States, we heard from the Bureau of Labour Statistics yesterday. They, of course, are releasing the October and November jobs report a little bit later on today. The BLS noting that the November household survey has what they're calling a slightly larger standard error, and that this may last a few months. Before anyone gets too excited about this is very, very technical, and it relates to the fact that they do the household survey in waves. So you get a constantly changing panel of people responding to the survey. And obviously, because they're not collecting the October data, they have got 2 new waves coming into the survey, which may have a very, very minor impact, but it's not going to be huge. Moving away from that into a bit of corporate news for the crypto people out there. JP Morgan, they have started a tokenized money market fund on Ethereum. Great, if that floats your boat. Meanwhile, Goldman Sachs and Bank of America, they are headlining a group of investors putting 20 million quid into the Texas Stock Exchange. Of course, that is going to, or is scheduled to begin trading in 2026. And it's one that we are definitely keeping a very, very close eye on, given the potential, or the likelihood, I should say, that actually we see SpaceX listed on that exchange. And in other exchange news, we heard overnight that NASDAQ, they are reporting, this is, the people who run the NASDAQ indices and the NASDAQ exchange, they are reportedly planning to put some paperwork into the SEC for 23/5 weekday trading. This is according to Reuters, citing sources. I think it's a fucking terrible idea, but it seems to be the way the world is going at this point. Moving on from that, news broke last night from Ford in the auto space. They are going to cease manufacturing of the electric vehicle version of their F-150 pickup truck. They are basically redoing the entire electric vehicle architecture of the firm. And in order to do that, they're going to take an accounting charge of about $19.5 billion, with a be, which is absolutely huge.
I've got to say, funny enough, the timing of this is pretty spectacular, because we did actually mention yesterday that people, like firms, are finally waking up to the need to drop the EV mandates that they've self-imposed. So just one quickly to chat about the NASDAQ, because it was on my list of things to talk about anyway as well. There'll be a lot of people like me and Michael saying, "Oh, this is terrible news." People need a break and stuff, but I think it's impossible to fight the wave that is coming with this, because we're starting to see a number of exchanges kind of skirting around regulatory burdens and whatnot to offer more round the clock trading. So the fact that NASDAQ are getting involved and try to do this via their official kind of marketplace, the exchange, I actually think this is a good idea, because hopefully it will remove some of like the cowboy firms that are kind of coming in and taking this on in America, so it's an interesting one to watch. Don't get me wrong, it will be disastrous for anyone that want to keep some sanity, but I think it's pointless trying to fight the tide on this one.
That's actually not bad framing of it, to be honest. I mean, as you say, I'm fully with you. I think it's a terrible concept, but if it's a concept that's got legs, and it seems like it does have legs, it's better that they're official legs rather than unofficial legs.
Exactly that, because otherwise it will just be like
non-connected.
Non-connected like pools of liquidity, and it's ripe for kind of manipulation. It's like when at the start of the Bitcoin kind of phase, and when you had like fucking about 50 different Bitcoin exchanges, it all trading different prices, different exchanges, people getting stopped out when other people weren't getting stopped out at the same price, all that bollocks. I think if these stocks are trading on NASDAQ, then this make them trade on NASDAQ for the full duration where they should be trading. Just a quick one with this EV story with Ford. Obviously, we spoke yesterday about platinum screaming higher on the back of this change, which obviously continued, and also it's why nickel is suffering. And Clive just messaged us to remind me of that one. Hence, quote Clive Lambert, this EV story is hence why nickel is shitting itself, because obviously a big battery metal. There you go.
Certainly one way to put it. Cool. Just three final things from me in the tech space. NVIDIA, they have demonstrated and debuted something called the Nematron 3 family of open models.
Normal naming conventions, please.
Tom Talks Cars, if you're here, please inform us of what that is. And lastly, a couple of headlines on OpenAI. They have hired a chap called Albert Lee from Google to lead M&A for the firm. M&A and IPOs are going to be a big old theme in the AI space in 2026, I think. And lastly, Axios, also on OpenAI, reporting that them and Mattel, of course, the toy company, they will not be releasing their AI toy in 2025. What a shame. I was hoping for that for Christmas, whatever the fuck it is. But there we go. We'll have to wait until next year.
Oh, lump of coal for you. Is that you?
An orange.
An orange. What to put in your mouth? Whoa.
I don't even fucking like oranges.
Just use it as a ball gag.
Oh, God.
Right.
No.
The overnight news roundup, courtesy of me, because Zach's not doing it today. So hold tight, everyone. Right. You've already covered the Ford story. Thank you very much. I do follow the Substack, etc., etc. Shadow banking hits $250 trillion, and regulators are shitting themselves. According to Bloomberg, global banking assets have crossed $250 trillion for the first time. The Financial Stability Board is warning about mounting systemic risk from these less regulated corners of finance. All dark and murky. What else we got? Canada approves $50 billion Anglo-Tech mega merger. Canada just approved the Anglo-America's acquisition of tech resources, clearing the way for $50 billion copper mining giant focused on Chile and Peru. This is one of the biggest mining deals in years. Sticking with kind of commodities, oil extended its slide to the lowest price since 2021 as traders bet the Ukraine ceasefire could flood an already oversupplied market with cheap Russian crude. Gold, that surged more than 60% this year, its best annual performance since 1979. Central bank buying and investors fleeing bonds and currencies are apparently fueling the historic rally. Obviously, you're hearing a lot of these year-end prices at the moment, so it's not really that news because everyone should be aware of this, but it's what headlines do and what papers do these days. Like look back at the year and that kind of stuff. The EU is scrapping its effective ban on combustion engines after months of pressure from car makers. VW, Stellantis and others warned the rules were killing the industry. Again, this is something that we've been hearing a lot of, but it looks like it's being made official. And I think it's only the UK that's left to go now, right? Which knowing our luck, Ed Miliband won't change a thing. President Trump, he's suing the BBC for defamation over its editing of January 6th speech, seeking up to $10 billion in damages. I actually thought it was maybe a lot more than that, but there we go. That'd be an interesting one to follow. I think I've also seen headlines saying 100 million, so we'll see what he's trying to do. On that front,
Bread.
bit of a spread. Chinese stocks tumbled to key bearish levels as fading tech gains renewed growth concerns fueled by a sharp sell-off. Apparently, according to people on Bloomberg, the Chinese stock rally is running out of steam. Bank of Japan expected to raise rates to levels not seen in 3 decades this week. The yen is outperforming all major currencies as trader position for the hype. Sticking with Japan, they just approved its largest post-COVID stimulus package, $118 billion in extra budget spending. What else we got? PayPal has filed for a bank charter as it pushes deeper into lending markets. The fintech giant is making its biggest move yet into traditional banking territory. And global smartphone shipments, they could fall 2.1% next year as the memory chip shortage drives up costs and squeezes production. Apparently, the chip crunch isn't over. Hong Kong's IPO market, finally for me, has raised more than $34 billion this year, and December is the busiest month for listings in at least 4 years. And companies are rushing back to go public. And that's it for me. A nice short and sweet overnight news roundup. Obviously, check out the Substack for the full gamut of headlines. But back to you.
Good stuff. Thank you, Ryan. I'll get on to the jobs report momentarily, but before I do, just to run through a few other bits and bobs that are happening today. At 9 o'clock this morning, in about 7 minutes' time, we will be getting the flash Eurozone PMI data for December. All of the metrics, manufacturing services and the composite output gauge, expected as near as makes no difference, unchanged from where they were in November. And then we also get flash PMI figures from the UK at 9:30 this morning. Again, everything expected as near as makes no difference, unchanged from where we were in November. Although you would look in the UK data to see whether the alleviation of fiscal uncertainty has boosted the numbers somewhat. And also, just lastly, before we get on to the payrolls print at 1:30 this afternoon, at the same time as that jobs report, we also get the October US retail sales data. Sales seen having risen by 0.1% on the month in October compared to the 0.2% rise that we saw in September. As I was saying to someone earlier on, it was Lint, our mutual friend, that I doubt anyone will focus on retail sales unless it is an absolutely huge outlier. And the reason for that is, of course, it is jobs day. So at 1:30 in the afternoon London time, 8:30 this morning on the east coast of the States, we will be getting our final set of US labour market data for 2025. In terms of the running order, the Bureau of Labour Statistics are going to be releasing the entire November jobs report as normal. So payrolls, unemployment, earnings, etc., etc., etc. And they will then also release at the same time the establishment survey only for October. What that means is we will get an October payrolls print, but we will not get an October unemployment rate number. So do be very, very careful in terms of interpreting this data. I mean, if you are trading it, 1, you're mental, but 2, please be extra careful that you are interpreting the correct month's worth of data, as all of this hits newswires and hits squawks. It could be very, very messy indeed a little bit later on. For the purposes of this preview, unless I state explicitly otherwise, I'm only talking about the November data from here on in. In terms of headline non-farm payrolls, consensus sees payrolls rising by 50,000 last month, though the range of estimates is wide as ever, from minus 20k on the downside to plus 125k on the upside. Leading indicators on the whole lean positive, with the ISM manufacturing and services employment gauges having risen to their highest levels since May, initial and continuing claims having fallen nicely between the 2 survey weeks as well. In fact, the only sort of blot on the coffee book is the ADP employment metric, which pointed to private sector employment having fallen by 32,000 last month. In terms of the November data, obviously we'll continue to look for whether there's any skew in there from the government shutdown, but also be looking out for any temporary hiring around the holidays, of course, Thanksgiving and in the run-up to Christmas. So you'd be expecting, if not hoping, for a very, very strong leisure and hospitality print when that data comes out later on today. In terms of average hourly earnings, they are seen rising by 0.3% on the month and by 3.6% on the year in November, which should reinforce the FOMC's view that the labour market is not a significant source of upside inflation risk at the current time. And then in terms of the November household survey, unemployment, that's seen rising to 4.5% compared to the 4.4% that we saw in September. Do note that last time out, the September unrounded unemployment rate was 4.40%. 0%. So the bar for that to round up to a nice 4.5 is very, very low indeed. Labour force participation, meanwhile, that's expected at 62.4%, which would be unchanged compared to where we were in September. In terms of money market pricing, for a bit of context around the figures, the swaps curve at the moment sees about a 1 in 3 chance that the Fed deliver a 25 basis point cut in January, about a 60% chance that they deliver a cut by the end of Q1, with a full 25 basis point cut discounted by June, although of course those odds are largely skewed by expectations that the new chair, who will be in place by that point, is going to be considerably more dovish than Chair Powell is at the moment. Do bear in mind, in addition to that, of course, while the Fed remain in this data-dependent mode and their reaction function tilts almost entirely towards supporting the labour market, we will still be getting the December jobs report in early January, in plenty of time for the January FOMC decision. So while the market will be potentially all over the place on the data we get later on today, I think the policy implications of the figures are probably relatively limited, not least considering that the Fed delivered 25 basis point cuts last week and in October, despite not having any of these employment figures. So do just bear that context in mind.
Just with that in mind, and also the fact it's kind of Christmas markets and et cetera, and these releases are fucking ridiculous to try and trade anyway. How many times have we said in the past, you could tell me the data an hour before the release?
If I had the payrolls number right now, I'd still lose money on the trade.
Yeah, no, exactly. And that's one of the things I've been saying for years. Like, it's been a running joke, but like in this instance, now more than ever. So anyone sitting there trying to trade the headline, good luck, because the real money isn't, and you need the real money to follow it up. And there is a complete difference between quick money and real money on this kind of thing. So look after yourselves. Keep it. Don't fuck your trading account up this late into the year. Basically,
I was just going to say exactly what we started the show with yesterday. Do not fuck up your year with 4 days to go.
Yeah,
payrolls is a prime opportunity to fuck up your year. Sadly, despite our best efforts, there will be people out there who do end up doing that. Unfortunately, just make sure you're not one of them.
Exactly that. And on that bright, happy note, it's goodbye from me. It's goodbye from Michael. And keep it tight, stay safe, and we'll see you all